The Bank of Japan has finally acknowledged that the carry trade poses a systemic challenge, yet its attempts to address this with rate hikes are faltering. While officials hint at tightening measures, the yen continues to slide as major institutions resist this shift. By the end of this video, you'll gain insight into why the BOJ finds itself in a tight spot and what a staggering $17 billion retail bet could mean for the next market crash. Japan has become a testing ground for global monetary policy. The timeline reveals a staggering history. Zero interest rate policy began in 1999, followed by the first round of quantitative easing in March 2001. By January 2016, the BOJ ventured into negative interest rates and later adopted yield curve control. This decades-long era of ultra-easy money has birthed a carry trade monster that now seems almost impossible to dismantle without triggering global repercussions. The first attempt to unwind this carry trade has already sent shockwaves through the financial markets. In just one session, the Nikkei plummeted over 4%, wiping out approximately $400 billion in market value. Meanwhile, 10-year JGB yields are climbing to multi-decade highs, yet the yen stubbornly remains weak. This disconnect illustrates that even as the BOJ raises rates in an effort to address the issue, the overwhelming scale of global positions is overpowering their policy tools. On social media and trading desks, a massive $17.2 billion retail bet has caught everyone's attention. Japanese retail investors have quadrupled their net short USD positions since June, reaching levels not seen since 2008. These traders are effectively wagering on a significant intervention by the Ministry of Finance. If this bet pays off, it could trigger a complete collapse of the yen carry trade. However, if it fails, the potential losses could be historic. So why aren't the rate hikes translating into stronger yen? Analysts are pointing to a quiet rebellion among major institutions. Pension funds and insurance companies are reportedly resisting the BOJ's rate hike strategy, choosing not to realign their portfolios. Instead of bringing funds back to a stronger yen, these giants are opting to stay put, which in turn weakens the currency further. One analyst noted that while the BOJ has recognized the problem, they cannot compel the private sector to follow suit. The fallout from this carry trade unwind isn't just confined to Japan. Asian equities are feeling the pressure, with the Nikkei's 4% drop sending ripples throughout the region. In South Korea, margin calls have surged to 1.2 million retail traders as liquidity tightens. This serves as a clear signal. The yen's weakness is not solely a Japanese issue, it's a critical factor affecting global risk assets, and that fuel is now under threat. Despite JGB yields remaining at multi-decade highs, US dollar to Japanese yen remains stubbornly low for the yen. This reinforces fiscal anxiety and keeps intervention risk at the forefront of traders' minds. The market is essentially in a standoff between the BOJ's data-driven tightening measures and a global financial system that has become reliant on cheap yen. If the BOJ tightens further without institutional support, we risk a chaotic unwind of the current situation. For individual investors, the key takeaway is clear: policy intentions don't always translate into market realities. Keep a close eye on the July 30th, 31 BOJ meeting, it's a pivotal moment. Monitor JGB yields and signals of yen intervention from the Ministry of Finance. The current $17.2 billion retail short position against the USD reveals a dangerously crowded market that could either trigger a massive short squeeze or lead to catastrophic liquidations if the BOJ fails to act decisively. Looking ahead, our AI-driven scenario analysis outlines 3 potential paths. The base scenario predicts sustained weakness for the yen as institutions resist BOJ policy changes, pushing the Ministry of Finance into more frequent interventions. The bearish scenario warns of a chaotic collapse of the carry trade if the BOJ hikes aggressively, possibly causing another 5 to 10% drop in the Nikkei within a week. Conversely, a bullish scenario for the yen could emerge if pension funds capitulate and repatriate capital, potentially boosting the yen toward 140 against the dollar in short order. In summary, the BOJ has recognized that the carry trade is a significant issue, but their tools are currently ineffective against institutional pushback. Keep a close watch on the $17 billion retail bet and the upcoming July meeting. What do you think will happen? Will the BOJ regain control, or is the yen on the brink of a deeper crisis? Share your thoughts in the comments, and don't forget to subscribe for more in-depth analyses of the Japanese economy.